Hi, I'm in Bauer Hall 160. The mirroring on my iPad is not working. Yeah, and class is just now starting. Okay, thank you. Bye. All right, we'll get started in a moment. I want to get the technology going. Plenty of time to sign up for examples. They're all available.
Oh, I
Being honoring. Yes. Oh, it's that. Hey, is that thing ever? It is. That's what you did. Oh, since you used that. Okay. Yeah. Perfect. Okay. Thank you. All right. Good morning, everyone. Nice out there, right? Spring has arrived. Okay. So remember, we're talking about export benefits. So we're right in the middle of it. We're going to finish off the regime that that's in place up through the end of last year, which corporations will be doing tax returns for the prior year. And so we're going to compute FDII. That's what we're in the middle of trying to compute. And remember, this builds upon each other. DEI, DII, which is DEI less 10% return on tangible assets of the U.S. company, and tangible assets is QBI, and we're trying to get to foreign-derived DEI. So remember, this is an export benefit, so we got to look at your deduction eligible income, which is all income from the United States, but we're interested in what is foreign-derived, because we're not going to give a benefit and a reduction in 21% tax rate for U.S. to U.S. activity, right? That's just subject to 21%. So remember to have foreign-derived deduction eligible income. We got export sales of tangible property. We're in the middle of that. We're going to then talk about foreign provision of services. So service businesses, so it's not just tangible asset transactions. If you're in the United States and you're providing services abroad, that can avail of the FDII benefit. And then export licensing of intangible property, so exploiting your IP outside the United States with a third party who's going to, in exchange for access to that intellectual property, pay you a royalty back to the United States. We are interested in incentivizing that activity as well. But remember, the whole goal here is to incentivize U.S.-based activity to support foreign markets. We do that by U.S. manufacturing, export tangible sales, exporting U.S.-based services, and exporting sales of, or not sales, access to U.S.-based intellectual property via a royalty arrangement with a foreign party. That's where we're headed. So remember, for export sales of tangible property, I'm looking for how do I prove that this is an export sale? And that's where I have a foreign person and a foreign use requirement. And there's some safe harbors that the regulations have come up with over time to help ascertain and make it easier from an administrative standpoint for a U.S.-based company when they sell abroad, that the U.S. accepts that as an export sale. Because you're always worried about a few bad actors maybe doing something where they do an export sale, but it's destined back to the United States. So a round-trip sale, the government's trying to police that activity. So they want to make sure that you have a foreign person and a foreign use. So where we are is, let's talk about export sales of components. Okay? So many times what you're selling is not a finished product. It is a product that is going to go into another product and be assembled into a broader product. So if you're exporting component sales, that can count as an export sale if it could satisfy foreign use even when the final product is subsequently sold back into the United States. So we can't sell the product and then immediately sell the same product back into the United States. That's a round-trip sale. The regulations will stop that from counting as an eligible export sale, not being foreign derived. But if the component is sold by a U.S. exporter and it's substantially transformed by the foreign manufacturer and the final product becomes distinguishable from its original components, or the components sold to the foreign manufacturer are incorporated into a second product and the assembly activities are substantial in nature and generally considered constitute manufacturing. So I put over here in the box, these are trying to guard against pure round tripping. So there has to be something done in the foreign market with the component. And that can either be transformation, substantially transformed, right? You can imagine that's a subjective test, but something has to be done with that component, or it's sold and it's an assembly activity in the foreign country, and that assembly is substantial in nature and generally considered itself to be manufactured. There's a long-standing debate between the government and taxpayers whether assembly constitutes manufacturing. And it usually depends upon the degree of assembly and how much time that takes, how many components it takes, that type of thing, to consider that manufacturing, but it is possible. So an example of this, 726 is
So one of the key categories of FDDEI is export sales of tangible property, and this is the components problem that's used in foreign manufacturing. So here we have USCO, a domestic corporation selling components to F customer, a foreign buyer. The dashed line represents the US foreign border. The key question is whether the transaction qualifies as FDDEI, and the answer is yes. Assuming the activities meet the substantially requirement and satisfy the components test. The components test is pretty critical here. It requires that the exported property be a component that is ultimately used or consumed in the manufacture of a final product outside the United States. That test is met, the income from the sale qualifies as foreign derived, and the U.S. company can claim the FDII deduction, which, as we discussed, provides an effective lower tax rate on that income. So the takeaway here is if your clients are exporting parts, raw materials, or sub-assemblies, they should be evaluating whether those sales qualify for FDII. It's a benefit that's often overlooked in the component space.
Yeah, so the key thing here is if this transaction was destined for foreign customers, so the components were sent to F customer, assembled, and then sold in foreign markets, clearly you satisfy this because it's an export sale. The question here is when the products are assembled and are sold back to the United States, is that an inappropriate round tripping, or was there enough done by F customer in this example to consider that initial sale a good export sale? And the question is here, yes. In this example, they're taking all the component parts of sunglasses and putting them together. So you may think like, well, how hard is that? Put the screws in the arms and the frames and put the little nose pads on and everything. Probably not too hard, but the standard's pretty low for assembly to constitute manufacturing in this instance. So it's not, we're not looking for you're assembling a car or an airplane or something like that. Those clearly count, but it can be relatively less than that. But keep in mind here, if it's destined for the foreign market, you don't even have to look at this, right? Because the component sale will count. This is just when the assembled product is shipped back to the United States. Okay, perfect. Thank you. Okay, foreign provision of services. So remember I said, once something like this gets opened up and the government's considering this, all the taxpayers come in with their cases, right? Oh, I see you're talking about tangible asset sales. What about the services companies? That counts, right? Shouldn't that count? How do we get services in this? So they were successful in arguing that. So a U.S. company providing services from the United States to a foreign customer outside the U.S. can qualify for FDDEI. This is Katie. U.S. Arch. I wonder if they're in St. Louis. Okay, go ahead.
U.S. Arch provides architectural consulting services. Jericho, a German construction company, hosts a meeting in Munich and invites U.S. Arch, whose personnel travel to Germany to participate at the meeting. Because Jericho is benefiting outside the United States, these services result in foreign-derived deduction eligible.
So this will count and go straight in just like a tangible asset sale. So I like to think of it as exporting of services is what you're doing. But these are U.S.-based people. They're just providing the service in Germany. Now, if you switched up these facts and this German company was talking about expanding in the United States, and the German company came to the United States at the place of location of U.S. Arch and had a meeting to talk about expansion in the United States, that is not an export of services, right? So this is for services in Germany, and we want to incentivize U.S. people to do that, so therefore we give the deduction for FDII for this type of activity as well. Perfect, thank you. Okay, as you can imagine, some people came in and said, whoa, what? I do services, but I provide them electronically. I don't have people that do this and travel. Surely you want that to be incentivized as part of this as well. You can see where these regimes, when they open up, you can be opening up a can of worms as an analogy, where when do you stop? And that's where the government has to decide, like, okay, how big do we want this to be? And how much is it going to cost us from a budget perspective, right? Because if I give a deduction for certain types of activities and I keep expanding it, that's going to be negative to the budget deficit that we run here in the United States. But electronically supplied services do count in this regime. Those are ones provided over the internet. They could be via the cloud or digital streaming, and give rise to FDDEI depending on the location of the customer's IP address. 728 is Claude. Okay, I'll do this one. So U.S. Arch again provides architectural consulting services, so doing the same type of services. Jericho, a German construction company, hosts an online meeting in Munich and invites U.S. Arch to participate at the meeting via the internet. Because Jericho benefits by accessing the electronically supplied services outside of the United States, the architectural consulting services result in FDDEI. So very akin to, instead of physical people moving down there, I just supply the service over digital means, and the foreign party can access that in Germany. That will count as an export provision of services. Okay. Thought I just did your example. Sorry. So that will count just as much as physical transfer of services via people. Okay. So export, sale, and licensing of intangible property. I want to cover those separately because this is a distinction between the FDII rules, which were 18 to 25, and our new FDDEI rules, which is post 26, One Big Beautiful Bill Act that we did. So I'll take the second one first. So the licensing of intellectual property, that's the one, the rule is the same under FDII and then prospectively, the rule is the same. So this is the idea that we want US-based intellectual property. We want to develop new intellectual property in the United States and then license that abroad. Okay? When we license it abroad, what we get in exchange is a royalty coming back to the United States. Royalty is gross income. We're just going to give a percentage of that as a deduction. 37.5% of that income will be a deduction, the FDII benefit. The reason I highlight the export sale here as being different. So remember I said the Tax Cuts and Jobs Act of 2017, very quick negotiation, quote, negotiation. The Republicans passed it in 6 weeks from start to finish. So the law actually allows the export sale of intellectual property to count as FDII. Now, that caught some people off guard because you're allowing the sale. When you sell something, it's gone permanently, right? So exporting your intellectual property, that sounds the exact opposite of what I just said that the rule was trying to encourage, which is US-based ownership of intellectual property. But we're given a less cost if you sell the intellectual property and it's gone from the United States. So the reason I highlight that is that does count from 2018 to 25. But they came around to it in the One Big Beautiful Bill Act of last year and they took out export sale. So the export sale no longer counts as DEI, deduction eligible income, which if you go back and look, that's one of the building blocks here. It's not even in that. Remember subpart F, guilty, it's not DEI, neither is an export sale of your intellectual property, which makes sense in the overall premise of the regime. So the sale of intangibles for purposes of FDII and royalties from the license of intangibles can constitute FDII if the foreign person and foreign use requirements are met. I still have to have that foreign element to this in order for the regime to apply. The foreign person requirement is met if the intangible property involves a retail sale to a foreign person, or in the case of non-retail sales, there's a foreign billing address. So again, there are some safe harbors, and it's pretty tortured reading of the regulations, but allow some level of comfort that a U.S. company can say, I did this with a foreign party, therefore it counts as a foreign-derived deduction. The foreign use requirement is met to the extent the intangibles are exploited outside the United States, as you would expect. You're using the IP and you're paying for it for use outside the United States. That's exactly what we're trying to encourage. Okay, 732 is Eugene.
US Cola licensed the secret formula for a drink to Ford Cola. Ford Cola uses the formula for which foreign revenues constitute 98% of revenues, and US revenues constitute only 2% of revenues. Because 90% of revenues are earned from foreign customers, 90% of the royalty constitutes FDD.
So we own the IP in the US, and we're providing access to foreign cola, for cola. Access to that via a license, and we get a royalty in exchange for that. So we then need to understand what is For Cola doing with that intellectual property, that access to the intellectual property. Obviously, they're driving sales. Here we look to where are they exploiting the intellectual property. They're doing that largely with foreign customers, 98%. So 98% of our royalty income stream will qualify for FDDEI. It'll be the foreign-derived element of the deduction. 2%, That could be from any number of reasons. That may be Cola has some niche market in the US and then licenses it back to the US, but that won't count because that doesn't do the foreign derived portion of the Okay, comprehensive example. I don't know, did anybody sign up for this or want to do this one? Okay, so this is pulling, come on, what? So this is pulling it all together. I want you to, if you could do 716 and the next version of 716, you will understand this entire chapter. Okay.
Example 716, a USC corporation earns income of $10 million from selling manufactured products. That is $5 million domestically and $5 million abroad, and owns $15 million of tangible assets. So the deemed intangible income is $8.5 million, which is determined by $10 million of deduction eligible income, less 10% of the $15 million of tangible assets.
Let me pause you there. So I put the formula in the box, right? So we know what DEI is, right? If you go back and you look at the notes from last week, DEI is very broad. It's all income, accepting out subpart F and accepting out guilty, right? So that's 10 million. And then this, we reduce it by 10% return on our tangible assets because we're trying to get to our deemed intangible income. So we do that objectively by giving an arbitrary return to tangible assets, and everything else has to be intangible. So that's, they give us, how much is the amount of assets here? 15 million of tangible assets. I get a 10% return on that. That's 1.5. Subtract that from the 10 million of deduction eligible income. That's the 8.5. Right? Okay. And then we got to do this side of the calculation over here.
So because half of the deduction eligible income is earned abroad, half of the 8.5 million, that is 4.25 million, is FDII.
So that's this is 5 million all over 10 million is that fraction, because 5 million is my export sales and 5 million is not my export sales. I'm not going to get the sales to U.S. customers, that's taxed at 21, and I get the deduction for that. But half of my DII can be FDII, foreign derives, right? So I know the words can be confusing, but we're trying to approximate DII, or deemed intangible income. Then how much of that is foreign? And that's the fraction 1/2 in this example. So half of that is my foreign derived intangible income, right? And then it finishes off with a punchline.
So the USC corporation may take a deduction of approximately $1.6 million. That is 7.5% of 4.25 million.
So the 4.25 is my FDII, and the net result of this regime is I get a 37.5% deduction for the amount of my FDII. I get a deduction of 1.6. And pre-Tax Cuts and Jobs Act, pre-Trump 1.0, this was all taxed at 21%. So this is intended, again, to be that carrot to say either hold your intellectual property in the United States, build your next batch and develop your next batch of intellectual property in the United States, and if you have intellectual property outside the United States, consider bringing it back, because we're going to give you a lower tax rate. And I think the effective tax rate with only 62.5% being taxed is like 13.125, I think. So that's the carrot. Could be taxed at 21, but we'll tax it at 13.1. Okay. Thank you.
The diagram is just
Yes. So I think this is a key example because it pulls together everything. But you just gotta don't get lost in what the abbreviations are. Just think through what they're trying to get to. Start off with a very broad deduction eligible income. We want to get it down to intangible income. Then we want to say how much of that comes from U.S. versus foreign. And the foreign piece is what will give the 37.5%. Okay, thank you. Okay, so that's FDII. Huge benefit. Very, very popular with corporate America, right? Income streams that are lower tax rate, it's perfect, right? I can lower my effective tax rate. Plus, I think corporate America, as a general matter, likes to have things closest to the C-suite, closest to headquarters. So if they can have the intellectual property, like I mentioned, in the United States, they know the law in the United States. We value intellectual property and we protect it in the United States, so there's access to our court system. There's more control over the activity the closer it is to the home office. Okay, so we had the One Big Beautiful Bill Act in January 4th of last year that started January 1 of this year. So prospectively, this regime stayed alive, but the government tweaked it, right? Remember what happened in the One Big Beautiful Bill Act? If you're in my individuals course, you knew that there were certain individual income tax benefits that were going to change to the negative. Most taxpayers were going to have a tax increase as of January 1. So that caused our normal paralyzed Congress to actually move because people vote and they didn't want tax rates to go, or tax burdens to go up. So a bill was being opened. And the Republicans were in favor of it. They had the House and the Senate and the presidency, obviously. And so then the noise around this system from the prior, 6-7 years of it being in effect, the government then addressed this system as well. But keep in mind, the impetus behind the One Big Beautiful Bill Act was the changes in individual tax rates that were our tax rules that were going to change, and corporate America jumped in once the bill gets opened. Okay, so luckily here, what you just learned is going to be very beneficial because they just changed parts of it. They didn't rewrite the whole thing. Okay, so the One Big Beautiful Bill Act tweaked portions of the FDII regime, necessitating a name change to Foreign Derived Deduction Eligible Income, FDDEI, which was one of those components that we computed, right? We were computing FDDEI at the start of this class. We knew what DEI was, and we were computing the foreign derived component of that. That's all we have to do is we just stop there. We just use that number. So key changes made to the FDII regime to arrive at FDDEI beginning in 26 include removing the deemed intangible income component. Remember that component had the oddball result of reducing the base for tangible assets held in the United States. If I just told you that and you didn't know anything else, you say, well, that's a weird thing for the Trump administration to be in favor of. They're trying to incentivize companies to build in the United States. So why do we have this as a disincentive? Even though maybe it's a small disincentive, it's still a disincentive. So they took that away, took that out of the legislation. So now the benefit, so it drops the rather counterintuitive incentive to hold tangible assets outside the United States and allows capital-intensive corporations such as manufacturers to benefit incrementally more from the deduction. So think of your car manufacturers, Caterpillar, John Deere, major manufacturing companies based in the United States. If they had to reduce their DEI to get to DII by 10% of their tangible assets, that greatly reduced their net benefit. And then, obviously when they were raising their hands saying, we're doing exactly what you want us to do, why do you have a rule that disincentivizes what we already do? The government agreed with that. The other thing it does is it no longer penalizes, the reason that works is because it no longer penalizes them for having high domestic tangible asset balances. To be very capital intensive in the United States, you don't get penalized by a reduction of 10% of that balance. Okay. Secondly, DEI no longer needs to be reduced by the allocation of interest and R&E expense. You go back to your notes from last week when we were doing our first number, deduction eligible income. It was all income, less subpart F, less guilty because those are foreign items. And then we had to apportion and allocate expenses against it. That was SG&A, that was directly allocable expenses, it was interest and R&E expense. So now, we no longer have to allocate interest in R&E expense, research and experimentation expenses against the base of DEI. That's a big benefit to corporate America, because lots of them are highly leveraged, lots of interest expense that would reduce the base, and the point on the R&E expense is you're again disincentivizing us to put R&E expense in the United States because we have to apportion it against this base. Surely you don't want to do that. So those are both propping up the base for DEI. Other expenses must still remain allocated. We took two of the big ones away. What they did do is they lowered the deduction percentage from that 37.5 that Claude just went through in that example in 25 down to 33.34%. Importantly, if they didn't come in and change this, the Tax Cuts and Jobs Act, as enacted law, was going to drop from 37.5 to 21.875%. Remember, all that was budget gimmickry in 2017, so they lowered the deduction beginning in 26, thinking in 2017, 2026 is eons away, but we eventually did it, right? So they stopped it from getting too low, but lowered it from where it was in 25. So what you're effectively doing is, this is a good guy, this is a good guy, this is a bad guy. From corporate America's perspective, you took away the reduction for 10% of tangible assets. That's good. Get the base higher. Took away the apportionment and allocation of certain interest in R&E expenses, good, keep the base high, but you lowered the rate of tax, the rate of the deduction. The idea is that these two are better than the third. Plus, this is permanent, right? Remember, quote, permanent. The law will not change unless they affirmatively come in and change this. They have to get the votes to change this. This will not change in 5 years, 6 years, 10 years, just by virtue of the calendar change. Okay? So, corporate America likes this. It's generally going to be better for them, and it's permanent. Right? So they can budget that. And they appreciate that no law is truly permanent. It can be changed, but they dislike enacted law that's going to change by just the passage of time. Okay, so this is 716. I'll do this one since I just did the I did the FDII one. So this is the new regime, which stops at FDDEI, and I'm using the exact same facts, because there was not an example in the textbook, and I changed in red what changed under the One Big Beautiful Bill Act. So you can see, compare the prior example 716 to this 716, you'll see what the law was and what it is now. So, same facts. Exactly same facts from a business standpoint. We had 15 million in tangible assets, 5 million domestic sales, and 5 million foreign sales. So what's my fraction over here? I took away this 10% reduction for your tangible assets. That's gone, right? I took away DEI. I don't have DII anymore. All I compute is FDDEI, right? So I shouldn't say I took away DEI. I still have DEI, but I no longer have the fraction, right? So I do DEI, which is my all my income, less subpart F, less guilty, and now less my sales of intellectual property. So if I sell intellectual property, like I mentioned a few minutes ago, that does not count anymore. So that if I add that transaction, it comes out. Now all I have to do is, what is the foreign portion of that? That's all this stuff we talked about on export sales of tangible assets, export sales of components, exporting of services, exporting of intellectual property via a license. Same rules, right? They're not going to rewrite those rules, so those rules and regulations are still out there. Now, what I get now when you do this math is, because half of the deduction eligible income is deemed abroad, so half of the 10, so the base is higher. I don't have the 10% reduction of tangible assets anymore. So 5 million is DDEI, that's my foreign piece of my deduction eligible income, the U.S. corporation may take a deduction of approximately 33.34% of 5 million, a higher base, so I get 1.667. So slightly higher than what I had in the earlier version of 716, which is the FDII world. And I just point out here, this example does not have the allocation of interest and R&E expense. If that was factored into the original example, that being away, that being removed from the new calculation, probably would increase this number. My deduction eligible income. So this just, it's a lot cleaner calculation. The degree of administration around making sure that I got foreign derived deduction eligible income via foreign person, foreign use, all that stays in there because again, this is trying to measure that foreign element of this. So all of that is still there, but I got a much cleaner calculation and it's permanent. Okay. So what are companies thinking about trying to avail of this benefit, right? Anytime you dangle a benefit out there, companies are going to say, what do I need to do to avail of these benefits or enhance my benefit? So a U.S. corporation could increase its FDII by investing in its U.S. manufacturing footprint and serve its foreign markets by exporting product from the United States, right? So if I decide to my next investment, if I'm in growth mode, do I put that in Missouri or do I put that in Mexico? All other things being equal, I might put it in Missouri if the product from that manufacturing effort is going to be exported. Okay. So now that would drive foreign deduction eligible income, and that's a permanent law. I get a 33.34% deduction. So why wouldn't I do that? That would go into my model, right? If comparing and contrasting the two options I'm looking at. A U.S. corporation can increase its FDDEI deduction by moving or migrating intangibles back to the United States and then serving the foreign market by licensing them from the United States. So if I had this property held offshore, my global structure in the past, I might think about, do I bring it back to the United States? Okay, this is now a permanent law. I don't have to worry about it going away. I know what the rate is. Now they can always change that, but I have something I can rely upon, at least for that. Companies are thinking of doing it. Some have already done it. Some are maybe waiting for this permanent feature to be in the law to do it, but it is on the table for them thinking about it. Two reasons why. One, I get the benefit of this regime. Two, as a general matter, I like my intellectual property held in the jurisdiction I'm most familiar with. That probably has the as tight of legal protections around intellectual property as anywhere else in the world. Okay, all that being said, there are other FDDEI matters that bear upon the optimal business location of tangible and intangible. Right? You've heard me say, don't let the tax tail wag the dog. If you're a tax professional, I would sit there and say, well, the first two are perfect. Why are you doing this? This is going to lower our effective tax rate. Well, there's other reasons, obviously other reasons besides tax, why a company chooses to locate their manufacturing footprint and the holding of intellectual property around the world. Right? It may be nearness to a customer, it may be difficult to ship product. Very heavy? Is it cumbersome? Is it large? I don't want to ship it from the United States across the ocean. Maybe I want to manufacture it closer to my customers, right? Same thing with the intellectual property. Maybe it makes sense. I manage that intellectual property in Europe with European employees. Maybe it makes sense to be there. So you just have to balance the two. So whenever a company is looking at alternatives for investment or alternatives for reinvestment to, investigate where they should own assets. Tax is clearly part of that analysis, but it is not the only part of that analysis. Right? Educated workforce, legal protections, management of the assets. All of those things come in there. So it just so happens that tax could be a material number because it's a lower burden on the full net income of a return on an asset, but it doesn't always win the day. So just keep that in mind. Okay. There is compliance, right? Tax compliance. The government wants to understand this and wants you to report the information. So the U.S. exporting corporation must maintain evidence of the foreign person and the foreign use requirements have been satisfied. You could be audited on that, right? Government could say, I want to see your files on how you are testing foreign person and foreign use to make sure that these flows, you have that FDII determined correctly or the FDDEI. And the specifics of what is required vary by income stream. These rules, as I mentioned, regulatory, very convoluted. They vary depending on income stream as to how you support foreign person and foreign use. The form we had in the past was Form 8993, Section 250. That's just the code section that gives me this deduction for foreign derived intangible income. That accompanies the Form 1120, so it's a supplemental form that gets included with the tax return to claim the deduction for FDII. The latter portion of the appendix, Chapter 7, shows the completed Form 8993 based on all the examples that we went through. Until the IRS releases new forms, a U.S. corporation should try to use Form 8993 for reporting FDDEI beginning in 26. They will come out with new forms. As you probably have been seeing in the headline press, the IRS has less people right now, so it just takes time. Things move slower for them, but they will come out with a new form for the FDDEI regime, so that it'll just be tweaked a little bit, so it'll capture the same type of information. But the record keeping requirements stuff will be really the same. What it won't have on that form is obviously the 10% deemed return on tangible assets. Okay, so we did FDII and we did FDDII, which just differ based on the year you're in, and some planning to avail of the benefits. I think if you just work through the examples, don't get lost in what the words mean, or what the words, the abbreviations mean. Think of them as building blocks, starting with DEI, gotta get to FDEI. So just keep working through them and you'll get there. Okay? All right. We are going to switch to Chapter 8. Which is outbound planning. Okay. So here we're going to start, this is going to be like the mirror side of our inbound planning that we did a couple weeks ago, where we did foreign persons investing in the United States. Now we're advising U.S. persons investing abroad. And what are the things that we're going to be looking for there? So I'm going to look at this in terms of an evolution of how a company starts to get more and more comfortable with a particular country. At what point do we trigger foreign country taxation? That's going to be very important. And then the alternatives for accessing foreign markets. And then we're going to go through some outbound tax planning, probably on Wednesday. But what things does a U.S. multinational find important when they're investing abroad? And we're going to spend a little time on the financial reporting, and then there's a comprehensive example, which is very similar to the comprehensive example in format as we did for inbound. Okay. So, in recent decades, most industrialized companies have significantly reduced their corporate income tax rates compared to historical norms. The corporate tax rate in the UK is 19%. It averages roughly 20% in EU countries and 25% in China. So as a general matter, if you look over time, most countries have been lowering their tax rate. Very few countries are going the opposite direction. Why? There's a global competition for capital, right? And investment. Capital and investment deployed in your country means jobs. So you can't be the outlier. As I just mentioned, if somebody's looking at modeling two countries and you have an outsized high tax rate, you have to have so much more in your favor for the company to choose to invest in your country. Right? Because it's going to be very significant to overcome that differential in tax burden, especially when the rest of the world is lowering. The export benefit regime. The U.S. has a 21% tax rate, but in certain instances, we tax income streams at lower than 21. So if you're in the 30, 35 tax rate, it's just going to be very hard for you to compete with new capital in the world marketplace. We know in the Tax Cuts and Jobs Act of 2017, Trump 1.0, the Republicans lowered the corporate tax rate to 21%, significant reduction from its historical rate of 35. All the years prior in my career was 35%. That was towards the top end in the world. The U.S., I think the mindset, one, stars didn't align to get the votes to pass the law to lower the corporate tax rate, but at least some of the thinking was the United States had so much going in its favor that they could get away with having a higher tax rate because of our consumer market, because of our natural resources, because of our legal system, because of our educated workforce. All these things made up for the difference of a higher tax rate. I think there was a growing groundswell that when the Republicans had control that lent itself to a realization that 35% was way too high. So if we stuck at 35 and everybody kept coming down, we started getting further and further away from the norm. So the idea was to get comparable. We don't have to be the lowest, because again, we have all those things going in our favor as a country, but we need to get more competitive. So the idea was to lower from 35 to 21. Keep in mind, we do have state tax for corporations, most states, and that can range from 5 to 10%. So most companies will look at things not just from a federal, but from a state perspective. And so that can be different in different countries that don't call their provinces states and things like that, but there's a two-system tax. Like in Canada, there's a federal tax and a provincial tax. In Germany, there's a federal tax, there's a trade tax, but it's a local tax and a federal tax. So you have to look at the total tax burden. So we might be 21, but we do have a state tax burden, and bump that up closer to 30. The tax implications of how a company enters a foreign market and where it places its next investment are critically important, but there are numerous non-tax business factors that also bear upon those decisions. So we always put forward the tax ramifications and modeling, the pros and cons of multiple alternatives, but they don't all, the lowest tax answer does not always win, right? Lots of different reasons that are not tax related where a company might nonetheless go to a higher tax jurisdiction. There are several options available to a company that wishes to expand internationally. So again, think of this as evolution. I'm considering going into this new country, this new region of the world. I may not go full board, right? I may not start a local corporation in that country yet. I might want to test the market for a number of years, understand the market, see if they like my product, like my services. It may take some time before I get to that point where I decide to have that type of exposure. So I may export my products through independent brokers or distributors, tapping the latter's relative expertise regarding foreign markets, international trade, and customs. Right? Many times it's more advantageous to start with a local business partner to help you get your product into the country, to get it distributed through the country, and understand how the market works while you're learning it, right? Instead of you trying it from day one and having fits and starts as you're trying to get it done, right? You might rely upon a foreign partner in this. There are costs to such an arrangement. You need to share profits. The third party's helping you. You are not going to get 100% of the profits, right? They're going to siphon off some of that product, or some of that profits from that product stream. And the lack of control over sales and distribution, right? You are ceding some level of control if you let a third party in the supply chain, and one, they're going to be compensated, and two, they're going to do it the way they do it. And that may not exactly sync up with the way you want to do it. You could take both of those things out over time, but in the early stages, you might be benefiting from them providing access to the market while you're learning that. As your sales and experience grow with that country, you may wish to bring foreign sales activity in-house by having US-based employees travel abroad to identify customers, display inventory, negotiate sales, and provide technical support, right? As you become like, yes, we're destined for this particular area of the world, I may want to take more of the profit stream in-house and more of the control in-house. I'm going to use my employees to do that. A next step could be the establishment of a foreign branch. So I start doing a little bit more in-country to conduct advertising, promotion, storing merchandise, conducting market research, working with customers, and I may employ residents in the foreign markets to perform such functions, right? So first I might have US people traveling to do that. Then I start saying, well, this is going to be more of a permanent activity. That really doesn't make much sense. I'm going to organize an office or a branch, and I'm going to start hiring local people to do that. That's a natural progression of my international investment. Licensing and franchising represents indirect methods of accessing foreign markets, whereby the U.S. company allows a foreign party access to its patents, trademarks, and other intellectual property in exchange for a royalty. I could do that, right? Instead of me setting up operations there, think of if I'm a restaurant chain. Years ago, I did a lot of, not a lot, I did some consulting for Panera. Panera grew out of St. Louis for those of you that didn't know that. St. Louis Bread Company is where it started. But as it went into other cities, they changed it from St. Louis Bread to Panera via some M&A transactions. But they got to a point where they were coast to coast and top to bottom in the United States. Everywhere was a Panera. So they started thinking, well, can I take my business model and expand it offshore? And one way they were thinking about that is taking their intellectual property, licensing that to a local restaurateur in Mexico, in Canada, in the UK. They also, I believe, Dubai, all public knowledge. But they didn't know that market. Right? They knew the feel of Panera. When you walk into the cafe, what does it look like, the pick two, all that stuff. But they didn't know the local customers. And they felt like a local restaurateur would know the local taste and what's important there. So they were thinking of one model was licensing. Instead of them opening stores in those countries, they would license the access to all their intellectual knowledge to a local restaurateur who would pay them a royalty. That's an indirect way of accessing that market, right? Getting a new income stream, but they don't get all of the income streams. It can be a relatively quick way to access the foreign markets because you might have somebody who has been doing business decades in that country. The economic return must be split with the licensee and the franchisee because you're not going to get everything, right? The sale of sandwich has to be split between the two parties. And the U.S. company may forego some oversight with respect to quality control compared to more direct expansion options. You can contractually try to have the quality control there, but it's not going to be the same unless it's your assets, your employees doing that work. You're just not going to have that same level of oversight. Ultimately, after all of this, the company may end up establishing a formal presence in the foreign market by forming a foreign subsidiary corporation, employ assets, employees in the foreign country to progress its international. Okay? You've done this for a number of years, you know the market. It's a target area for your growth. You might go full bore. I want 100% of the profit in this, and I want complete control over quality and customer relationships. So I'm going to take everything in-house. So that's going to be a wholly owned foreign corporate subsidiary that I form. I'm going to hire employees. They're going to be in my direction, and then I get all of the profit. But you normally don't start there. You kind of do all this other stuff in some version earlier as you get used to the foreign market. And there's no one right path or another, right? It's just how you Some companies might develop that over time from trial and error as they've entered into other markets. They may, this is what works best for us, but inevitably it's growing pains. It's learning what works best for your organization. Okay, so then triggering foreign country taxation. At what point do my activities usually give rise to foreign country taxation? That depends on several factors. The nature and extent of the U.S. company's activities within the foreign country. What are you doing? When I talk to companies when they're in these expansion modes, what do you plan on doing? Are you doing it with your people? And what are they actually doing when they're in the country? It's also going to depend on the internal laws of the foreign country, right? Every country has its own domestic laws. They're going to be different. There's no global law in this scenario. So each country, we need to understand what do they say you can and cannot do in my country before you trigger taxation. And then, is there a tax treaty between the United States and that country? That's where we might have a little higher standards, a little higher thresholds of what we can do before we rise to the level of being a taxpayer in that country. If we don't have a tax treaty, the only thing I have is domestic law of the foreign country. That's what it's going to tell me. And I have to understand that. That's the only way I can assess whether what I'm doing, or do I curtail what I'm doing so I don't cross the line of becoming a taxpayer. Why becoming subject to tax, why is that important? Two main reasons for a U.S. company. The U.S. company's current foreign tax credit profile, think back to international taxation in FAA. What am I from a foreign tax credit position? Am I excess credits? Remember, I have more foreign tax than I'm available than I am allowed to credit. We have a foreign tax credit limitation, so I have paid more tax than the limitation allows me to credit. Is this going to help or hurt that position, right? And it could be a positive or it could be a negative. It depends on, I would look at my existing profile and I would layer on these new facts if I become subject to tax, and at what rate. And then, secondly, complying with foreign tax law necessitates incurring incremental administrative costs. If I am expanding internationally, I am going to have more administration. That is a given, right? So if I come to the point where I'm going to be a taxpayer, I have to file tax returns. That's easier said than done. I might have to have a CPA help me do that so that I'm doing it correctly. These are areas where it's good to start off being compliant. If you wait for a number of years and somebody says, oh, you think you triggered taxation today, but I, as the auditor for the government, think it would happen 3 years ago, and you are in arrears 3 years of filing tax returns, that's not a fun place to be, right? You're trying to do business, and you're getting bogged down in the administration of doing tax returns for prior years. That's not a fun place to be. So I like to advise that pick a point in time, understand what the rules are, and say, okay, as of this year, I am going to start filing tax returns. And there's an old saying, that's my story and I'm sticking to it, but at least I start that. And if the government says, well, why didn't it happen last year or the year before? It's like, well, this is the year I started doing X. That's what I'm going to hang my hat on, is when I started. Right? Doesn't mean somebody can disagree with you, but you got to start somewhere, right? So it's impact the foreign tax credit position and complying with foreign tax laws is something. Okay. Most tax treaties with the United States contain a provision that exempts a U.S. company from foreign country taxation unless its profits are attributable to a permanent establishment. Okay. This is called the PE. We're going to talk in a couple chapters of tax treaties, and we're going to study the PE article. But for now, a permanent establishment is typically thought of as a fixed place of business. So think of an office, a facility, a factory, something in the name of the U.S. company in that country. So these are like branch activities, right? If I open an office, if I open a facility, open a factory, that kind of hard asset in country, that's going to get you a permanent establishment, right? These are just permanent establishment is a very, is decades old, so it's very much physical related. And exceptions are provided for fixed places of business used solely for auxiliary functions, think of purchasing, storing, displaying, or delivering inventory, or activities of a preparatory nature, collecting information about potential customers. Again, this is in a tax treaty context, right? Two countries to the treaty want to incentivize economic activity amongst the countries. They're going to have a relatively higher standard. So you can do some things without necessarily triggering a permanent establishment, right? You can purchase, you can store, you can display, you can deliver inventory in country, collect information. That's all business things. And everybody wants you to do the business, right? The governments are not trying to forestall you from doing that. They just don't want the tax burden to stifle the business activities at the earliest stages. That's the Importantly, a permanent establishment can also be created if employees or dependent agents habitually exercise the authority to conclude contracts in the country. So, I think of a permanent establishment, the bricks and mortar, and the other permanent features, you got boots on the ground. You got people, your employees in their country. And that doesn't mean that small visits to start gauging the market are a problem, but if you have people in the country meeting with customers and concluding contracts in the name of the U.S. company, you are likely going to have a permanent establishment under the terms of the tax. Okay? That's where you got to make the call. Either you let your people do whatever they want to do in the country, i.e. develop business, or do you put guardrails around it? Say, hey, you can go and meet with this customer, you can take them to lunch, you can have great meetings, talk about terms, but that contract has to be sent back to the United States for vetting and approval. Stop there from being a permanent establishment. Now, my experience has been typically your top salespeople hate that. Hate that. I'm sitting there, I have a great meeting with the client, they're ready to sign the contract, ready to make the order. And I gotta send this back to the head office. And they're gonna be like, customers like, why do you gotta do that? Are they gonna make changes? We just negotiated everything. So most salespeople like to be able to strike right then. And that's just where, as a business, you care about whether you become a taxpayer, i.e. create a permanent establishment by these activities, or are you trying to grow the business? I don't want to stand in the way of signing contracts with customers that want to be buyers of our product. Right? So sometimes this is where the tax department can not get their way as well, because business people are like, keep doing that, keep doing those contracts. I'll pay tax in the United States. Okay. So when the United States is a party to a tax treaty, we typically fall back to the historical permanent establishment, bricks and mortar, boots on the ground model for whether you trigger foreign tax. Remember I started saying at the start of this class that the world is changing. The OECD think tank in Paris has been leading an effort amongst the 30 largest economies in the world that standard is anachronistic. It's for the old world. It's not for the new economy, right? We have too many companies that can do too much business in a country without having bricks and mortar or having boots on the ground. Think of who those companies are. They all tend to be California-based high-tech companies making zillions of dollars around the world, right? Google, Amazon, those types of companies do not have to have physical place of business. They do not have to have employees. They can drive a significant amount of business from French customers without having any part of a permanent establishment. So the large economies of Europe started this concern years ago, and I will say it's mainly been France and Germany, they're big players in the EU, saying we need to lower the thresholds because these organizations, these companies are not paying tax in my country because the thresholds are for the old economy, not the new economy. You are accessing French customers and they're paying you for these services, and that's fine. But you are not paying anything to the treasury of the French government or the German government that give rise to the economic environment for our citizens to be able to pay you for your services. So you just need to pay your share. So this is called the Pillar 1 initiative of the OECD. We'll talk in subsequent weeks about Pillar 1 and Pillar 2 in great detail. Pillar 2 has moved in front of Pillar 1 from a momentum standpoint. And so it's odd, they were named when they originally were proposed, but Pillar 1 has just been, I think, languishing. It's probably a fair word to say, because you can imagine what I just told you. I think we could probably all agree that, yes, physical aspects of bricks and mortar and boots on the ground seems a little old from today's economy, but where do we draw the line? And that's where countries just have not been able to get consensus, and they have not been able to get consensus to a degree to get the U.S. to support the initiative. The U.S. has been somewhat supportive of Pillar 2. That's our guilty regime, is our version of Pillar 2. We'll talk about that in a couple weeks. That's the reason I think that initiative has moved ahead of Pillar 1, even though one's named 1 and one is named 2. Okay? So Pillar 1 is just languishing. The U.S. government is against it. Why are they against it? They feel it's unfairly targeting our high-tech companies. And those are some of the most valuable companies in the world. And they are paying tax to the United States because they are U.S.-based companies. If they start paying tax to Germany and France, what are they going to try to do? They're going to try to credit those taxes against their U.S. tax and pay less U.S. tax. So it's all about, remember we started with the share of the pie, who gets the slices of the pie. And the U.S. is not in favor of that. So Pillar 1 is out there. I think something might eventually happen, but it's just moving excruciatingly slow. But I think you need to be thinking about that because other countries feel like doing less than bricks and mortar, boots on the ground is sufficient to trigger taxation. Okay? So U.S.-based companies are worried about getting dragged into global tax disputes around the world on this particular matter. Okay. The evolution of these initiatives is what we got to follow, and their interaction with existing tax treaties, the position of the U.S. government. If we got midterms coming up at the end of this year, we have another presidential cycle. If we have a change in parties, that's going to change our interaction with the OECD. We might be more supportive of this. So this is on the radar, if you will, of what happens on Pillar 1. But it's on the minds of business leaders and international tax practitioners. Okay, so let's talk about alternatives for accessing foreign markets. And again, this is outbound. So we're either working for a U.S.-based company or we are advising a U.S. company on their outbound investments. So let's say the first way they are considering this is via export sales. So they're going to manufacture product in the United States and sell it abroad. So foreign country tax implications. Export sales through independent brokers and distributors should not create a taxable presence for the U.S. company in a foreign country under traditional non-Pillar 1 guidance, right? Because I don't have a permanent establishment. If I sell from the United States and I give it to DHL, and they take it into Europe and drop ship it into the customer's location, I don't have any physical connection to that country, as long as I don't have office, fixed place of business, or employees traveling in that country, including contracts. But once I start sending my own employees into the country in support of the export sales, that could create a taxable presence in the foreign country, depending on that country's laws and the applicability of the tax treaty. So once I start sending people over, I have to start then getting advice in that country as to what these people can and cannot do before I subject the U.S. company to taxation. But there are certainly lots of U.S.-based exporters selling abroad, and they just use third-party distributors, no physical travel of employees, and they're trying to mitigate their foreign tax exposure. The U.S. tax implications of such export sales, what did we just talk about? Export benefits. We'd love to get FDII or 26 and forward, get FDDEI benefits. So sales proceeds will be subject to current U.S. taxation. No doubt about it, right? Sales income is gross income by definition. But I might be able to qualify for those benefits. I need to support the foreign use and foreign person elements of those regimes must be met. And so at a minimum, I'm paying 21% on an income stream. It might be less than that if I can get some FDII or FDDEI benefits going on that. And proactively considering its future foreign tax credit implications, the U.S. company may want to establish foreign title passage. Remember when we had sales of manufactured product? Sales of manufactured product is sourced based on place of production. So it is U.S.-based manufacturing, that'll be always U.S. sourced. But remember, if it's purchased inventory, so I buy and sell. If my buy is in the United States and my sell is to the foreign customer, that might be FDDEI in the future, and I can get it to be foreign sourced for foreign tax credit purposes if I have title passage abroad. Okay? So that's thinking proactively when the business is thinking about this expansion is, hey, I'd really like to get FDDEI benefits and I'd like to get foreign title passage. You might not get that from a business perspective, but you could put forth that from a tax perspective.
Like certain regions of the world, or is it maybe like more on a country by country basis in which like certain areas like have a lot more change in their foreign tax laws? Because if I'm like anticipating that I'm gonna get these foreign tax credits and I'm like proactively like planning all my taxes accordingly, I would want to be operating in a country where like obviously their laws are changing very rarely. So are there like certain areas or countries where you try to avoid them because you're like they might change something in a few years, and now all of a sudden this like little hole in our tax planning is like not.
Yeah, there are certainly those areas of the world which are, and I would add to it, it's not just them changing their law, but the stance of their tax authorities being very aggressive in auditing transactions. And you know you're going to have a dispute. And so that can also be that, add an element of uncertainty to the market. So you guys have probably all heard that Ireland is a very favored jurisdiction for investment from the United States. Ireland goes out of its way to be very stable and non-confrontational. So they have a very low rate of tax, and they have sworn to everyone, we will maintain that low rate of tax. Who are they speaking to? They're speaking to the U.S. C-suite, who wants to hear the very things you're talking about. Stability, predictability, those types of things. And I'll contrast that to a couple countries. Brazil, famous for changing their laws. And it's a massive jurisdiction, right? It's the most populous jurisdiction in South America. So it's hard for U.S. companies to just ignore that market, but they know going in, it's highly unpredictable. And I'll take the one I was adding, which is a highly unpredictable tax authority. India is very aggressive in audits of taxpayers. So going in, you might have a dispute with India that's going to take you years to deal with. So that I think the business people just need to decide, do I deal with that risk by a pricing element? I charge more because I know this is all going to be really messy than if I do Ireland. I know Ireland is going to be what it is. So I think you just got to factor that in. And then at some point, does it become too much where I'm just going to avoid the jurisdiction altogether? That's just the business perspective. What sales could I get versus the headaches I'm going to drag to the table? Great question. So if I have export sales of purchase property, right, that's title passage, I might be able to influence that on the front end of my first export sales. Like, let's negotiate for title passage abroad. Let the customer tell me that they can't do that. Okay? So second alternative for accessing foreign markets, what if I license the intellectual property? Okay, licensing involves allowing another party's access to one's intellectual property in exchange for royalty. My foreign tax implications, I am not going to be subject to tax from an income tax perspective if I license to a licensee in a foreign country, but I may have to deal with withholding taxes on my royalty coming out of that country back to the United States. So that's going to depend on the foreign country's laws in the presence of a tax treaty. That's what that rate is, and the tax treaty typically lowers the rate of foreign withholding to 10% or possibly less, depending on the terms of the treaty that was negotiated. So my only foreign implications when I license is how much of my royalty am I going to get back? Am I going to get haircut with the big withholding tax? My U.S. tax implications, what we just talked about, foreign derived intangible income or foreign DDEI, that is, I can get that benefit for royalties that come in for foreign use of intellectual property, right? So it will be subject to current U.S. income tax, right? I can't get royalty income in the United States without having current income tax, but I might have a lower rate of tax if I qualify for those regimes. I still have that foreign person and foreign use requirements I have to sustain. And then if I do have withholding tax, I need to think about my foreign tax credits. Right? How does that impact my current position? So am I excess credit? Am I excess limitation? How much of this withholding tax, what's the rate of that? How does that impact? That could be favorable or negative to my existing profile. But that's what I'm going to think about when I'm doing outbound royalties, or I'm doing outbound licensing. Okay, real quick, organizing a foreign branch. A foreign branch is an unincorporated extension of the U.S. company into the foreign country. Right? I'm not setting up a legal presence. I'm just now like stepping into the country. I'm going to open an office or something like that. A branch operation determines its taxable income based on separate accounting, which means the branch maintains separate books and records and reports amounts that would be that the same activities performed by separate companies would report. Foreign country tax implications, as you would expect, I'm likely going to create a taxable presence. If I have a branch operation in a foreign country, I'm done enough to where I'm going to be a taxpayer in that country, and that's going to require me to file a tax return in that country. The amount of taxable income allocated to the foreign branch depends upon the risks and responsibilities assumed by the branch through its own employees. This is the transfer pricing methodology. How much does the branch activity add to the value chain on the delivery of the product or the service? So the more risk and responsibilities that the branch has, the more profit. The lower the amount of risk and responsibilities, the lower amount of profit. Right? And branches are considered circles or ovals on an org chart. So when you see a big, large org chart, if you see ovals around that, that means the owner of that has extended themselves into the other country on a branch basis. U.S. tax implications, the profits of the foreign branches will be subject to current U.S. income tax. If a U.S. company has the branch